Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we push out into the investing universe. The best way to do that is to follow me on X, formerly known as Twitter, at Focus Compound. If you're watching us on YouTube right now, this is our website, focuscompound.com. If you want to get access to our archive, our blog archive going all the way back to 2005, you could go to the website, click the blog section, and then you will have access to all of that. If you're interested in learning about our money management services, you can reach out to me at andrew@focuscompound.com, and we will start that conversation. So, Geoff, how's everything going on your end? Today is December 7th. Sometimes I feel like I should say the date. You know, it's like on YouTube, you'll see a video and it'll say, oh, this recorded 2 years ago. And then you go in the About section and they actually list the date, and it was like 4 years ago, 3 years ago. Like the YouTube when it was recorded is never accurate. So today's December 7th. How about that?
Yep. Mm-hmm.
How was Thanksgiving?
Good. Yeah.
Did you happen to go to the movie theaters over Thanksgiving?
A big Thanksgiving weekend. Yeah.
What's that all about?
Ever, I guess, in nominal dollars. Yeah.
Yeah, I mean, Cinemark, they put something out. Cinemark achieves all-time domestic records with spectacular Thanksgiving movie-going surge.
Yeah.
So you had Wicked, Gladiator 2, Red 1, and then, of course, Moana 2, which was, Moana was the biggest one.
Yeah. So I think in nominal dollars, I guess, depending on how you do it exactly, Wicked would be the third biggest or something, and it didn't even open. It was second, so two of the so they both be some of the top movies ever on Thanksgiving weekend. But adjusted for inflation, not as impressive. Years ago they used to have it. Basically, there haven't been major Thanksgiving releases for a long time. The Disney released things that didn't do well. They did Strange World and Wish the last couple of years. And so this is much bigger than that. Yeah. So
did you see any of them?
Okay. I've seen some of them, yes. And I'm going to see more.
Which was your favorite? I mean, was this the first time? I mean, I thought it was funny. So you have Red 1, which The Rock is in.
I've seen Red 1, yeah.
And then you have Moana 2, which The Rock's voice is in. So I was thinking about
it is the first. It's the first time ever that
I was wondering from a promotion standpoint. I was wondering.
I believe it is technically the first time that I can think of that anyone has ever had two number one openings in the same calendar month. That's a weird record, though. I think that other people have probably had, that I can't think of, two movies that opened within 30 days of each other at number one or something like that, but I can't think of anything that is in the same calendar month like this. It might be a record, some weird record that way. Yeah. Now, of course, he wasn't supposed to be in Moana 2, because obviously there's a big news about that, is Moana 2 was supposed to be a TV show. It was recut to make it into a movie, and his voice was added and stuff, but it was meant to be a Disney Plus show. So that's the amazing thing about it. It's going to be one of the biggest movies of the year, and it was never intended to be a movie.
Really?
And Red 1 obviously was pretty much meant to be online. That was the real reason for financing and stuff, is not that it was going to play in theaters. But
did Red 1 bomb? I mean, their budget was pretty high to begin with, right?
They have a ridiculously high budget, but
anything with The Rock's going to be like that, I feel like.
I mean, they'll make a fair amount. I don't know. Maybe it'll get to 90 millions. It's probably at close to 70 or something right now. And it's not going to drop very fast during as we approach the holidays and everything. So, yeah, I mean, it'll be worth it to have released it this way.
Look at the production budget, 200 million.
Yeah, no, that's crazy. But
the worldwide
there's
box
a lot
office
of
has been 151 million.
Yeah, but there's been things made for Netflix and all of those that are expensive. Apple, and some of them have been released in both movie theaters and then, you know, used online too. And some haven't been at all. So you make a lot. I mean, it makes sense to release them in movie theaters at this point, because this is whatever Red One is. It's going to probably, like I said, it could definitely make 90 million or something domestically. And it, you know, it doesn't cost you much to market it. In addition, because you have to kind of market it anyway. I guess you could just drop it on some service, but you kind of have to market it anyway. So, and like Moana, for instance, it'll probably help make the live action Moana, which was always planned to be a movie, you know, coming out in 2 years or something, bigger, because this came out, you know. It helps it helps advertise and everything. It'll probably have a bigger run on streaming things, you know, all that. It helps. So, but we'll have some more big releases to the end of the year, mainly Lion King. Mm-hmm. And then we will have like nothing for 3 months. It's like some of the worst I've ever seen. It's pretty shocking what is being released. I think there's a week in January where I think officially there's no, I don't know what the numbers has. I think there may be no wide releases at all the week of January, like 3rd or whatever. That's almost unprecedented if that's true. Do they have something? No, those are all limited. No wide releases at all. That almost never happens. And then, I mean, we have some shocking ones I could go through, but there's like, I mean, there's one that I think was made 5 years ago and is being released, I think, is among it. There's some pretty, there's some like horror things or something that might do okay, but you have almost nothing until like April or something. But you do have Lion King and Sonic left in this year, so this year will be fine. How this year will end will be good, but then expect really bad next 3 months, like shockingly bad. It's always a bad time, but it's gotten really bad in terms of how only during certain times of the year big things are released. Yeah.
Mm-hmm. Mm-hmm. I mean, if you look at the stock price of Cinemark and Marcus is obviously re-rated a bit. Cinemark is just crush it.
Did that? Yeah,
I know. When we were literally talking, like we were like, why is this? Why is Marcus not moving? And then I think that was the bottom there. But what do you do here, right? So, I mean, what are your thoughts for 2025 box office and then 2026? I mean, how much of those future box office improvements have been priced into Cinemark? Do you still think Cinemark could potentially be cheap at these levels? What would you be thinking if you held Cinemark at these price levels? It's gone up a bunch.
I mean, I don't think next year will be bigger. I don't think we'll be back really to, certainly not just for inflation, even in nominal dollars. We won't be back to where we were before COVID yet next year. So it'll be better than this year. But you'll probably keep improving into 2026 is my guess. 2026 looks better than 2025 right now. But a lot of that is outside of the major, biggest movies sort of things. Because actually, even this year, the biggest movies or something were fine. It's just like a lack of them throughout the year, and that's still an issue. So
lack of films.
Mm-hmm. I mean, I don't know. They do some things on the numbers where they estimate attendance or something. I think Deadpool and Wolverine estimated attendance would be very high. Like it would compare well to anything from 5-10 years ago any year. But there's fewer movies at like, say, 25-30 million people attending them, you know? And there used to be more of those. So there used to be more moderate hits. And there's less of that, mostly because like there's just less of the year where there were hits. If you remember this year, you know, until like Inside Out 2, and it wasn't, there wasn't a lot going on. Yeah. Mm-hmm. So
did you think Inside Out 2 would be big? Year. Would have been as big as it was? Did you expect that?
No, but the biggest movies of the year are always bigger than you expect. I mean, the numbers is a good example of that, and they'll even tell you that, where their estimates for how big movies will always be wrong for the biggest ones, because they'll estimate they'd be 300 million or something, and then there'll always be movies that break out and do 500 or something, but they don't know which movies they are. So the biggest movies are always bigger than estimated, basically. Like people had high estimates for Deadpool and Wolverine, but they wouldn't have been as high as it turned out to be or something like that. Yeah. So, I mean, compared to other stocks, yeah, they're not too expensive, movie theater stocks. I mean, even if we're talking about 10 times EBITDA or something, where EBITDA is likely to get better for next couple of years, yeah. I mean, that's not cheap for all times for the stock probably, but it's cheap for versus other stocks probably. So, yeah. But yeah, they've gone up a lot, obviously. I mean, Cinemark, it's over 100% this year, right? Out in the last year.
There we go. Year to date.
Year to date.
150.
Yeah. That's up a lot. Yeah.
Mm-hmm. And then you can even add on IMAX, which is another one. 72% year to date. Marcus now 56.6, which, as you can see, it started to really perk up beginning of October-ish.
Yeah. I mean, that's sometimes a surprise how that works out. But I also think to some extent they seem to be trading like just higher risk things, I guess, if that makes sense. They don't trade just on box office type stuff. They seem to do well when stocks in general are doing well, and, you know, higher beta things and whatever are doing well. It's not purely just how's the box office doing and how's it expected to do in the near term.
Mm-hmm. Can you believe that the market, I mean, total return 29% year to date?
Yeah. Yeah.
I mean, if you would have,
that's one of the, I don't know, but it's got to be one of the best in the last 25 years or something. It's got to be right up there.
And it just shows the timing. I mean, if you would have said the Fed was going, like, I mean, rates have just kind of marched higher, right? Like, at least the 10-year valuations are stretched. I mean, if you don't own Mag 7, I don't know how much you've participated, you know.
Well, you could have owned the box office related things. We just saw that. I mean, they're actually better than the Mag 7. Mag 7, what, like a Facebook or something's half of what Cinemark is probably.
I was talking to an investor in the fund, and our performance of the fund it's been great year to date. I mean, better than the market. And I said the part that sucks is we own nothing market related. We own no exposure to any of this, the beta or anything like that. And I almost feel like because the market is up so much, it's almost like, oh wow, it looks like we own a bunch of market related stuff.
Yeah, it's kind of weird how that
works out.
Happen that how amazing the correlation is when you own things that have no relationship to the market. Yeah, it's baffling sometimes that way, but that's the way that it is. A lot of things do go up, like I said, you know, they seem to be pretty highly correlated, some things. Now, there's other periods of time where that's not true, and that obviously wasn't true, you know, during COVID or something. Things were not moving together, right? Like there was the COVID type things that were doing well, and the COVID, you know, things that are harmed by COVID. So there's years where that wouldn't be true. If we were in an economically sensitive time, we would not see the same correlations. You know, you'd have like things that benefit from you know, cyclical type things, and non-cyclical type things would be doing very differently. It's just kind of loose financial conditions, some optimism, good economic results, and pretty steady. A lot of things can move together, you know.
Can you believe Bitcoin crossed $100,000? It was up to like 104,000. Even
so there you go. Bitcoin
Dogecoin's at like 40 cents now, up from 8, 9, 10 cents.
Yeah, so we just said you could own FANG things, you could own Bitcoin, you could own theater stocks. They all would show similarly shockingly good results. I don't know why the underlying fundamentals are similar, you know. So yep.
Crazy. Want to get your thoughts on Spirit Airlines bankruptcy.
Okay.
Equity holders are getting bageled, but more so generally on the industry. I had a joke that the Airaholic hotline was ringing off the hook. We've talked a lot about Southwest Airlines. You've written about Southwest Airlines a lot. Yeah. What are your thoughts? How does this bankruptcy affect the industry, if at all? Do you expect them to get acquired? What do you think?
Yeah, I don't know that it affects the industry that much. And some of these things, it might even only make it more possible that things could get acquired later. So it might not matter that much. That's kind of the problem with airlines, right? Is that usually, sometimes the government blocks acquisitions of things, it doesn't really result in a lot of capacity exiting because they don't end up, we're all
full on liquidation.
Yeah, someone ends up owning the planes and flying them, right? Or leasing them and flying them. Yeah. I mean, Southwest, hasn't been great, obviously. It had a very impressive run as a company a long time ago. And then as we kind of went over, there was some podcasts where we talked about it. It's become more and more like other airlines over time. And so, and then what we've seen with airlines is the things that are more exposed to international things, premium things, upcharges for things have done a lot better than the discount type things, right? So you've seen that too. But I don't know if that's unique. Dollar stores aren't doing that great right now and stuff. So that might be part of a larger thing where it's super low end. Things that sell based on really low advertised prices have not done as well in their industries as other kinds of businesses. That's pretty universal right now.
Are airlines in your mind just always in the too hard pile?
I don't know about that. I mean, in the United States, passenger growth is not that fast. Capacity is not growing that quickly. It's pretty mature industry, has fairly few players. It's been very hard for anyone to get in and stay in and be successful for a while now. It certainly looks like an industry that is investable. Yeah, it looks okay. Like you won't have the same kind of losses as before. But what does that mean? I mean, it might make it just like lots of other industries that aren't necessarily that great, but if they're cheap enough and if you expect better things for them for a while, then you'll do okay. But yeah, it seems like it's a very different industry than it was before. Yeah, I don't think it would be easy to start up new airlines in the United States and have any success with them or to come in. Yeah.
It's the bears to exit portion that I hate. I mean, it's not like they're scrapping planes and capacity comes out, and it just goes more to other people. That's the part that sucks about the industry. Like you said, somebody else will just buy them and fly the planes. So that competitiveness will always be there,
So it's a 1 year chart that we're looking at there for all of them?
Yeah. Mm-hmm.
Okay. Yeah. Yeah. Yeah, I mean, I think some of it, even like with the Buffett thing where he invested in them and then, sold out and everything, it was a one-time fluke thing about COVID, I think some of it is luck that way too. That could happen in lots of different industries. And the same thing would happen if you were movie things. You wouldn't be doing better off now than you were before then if you bought into them, and then you'd feel like you had to sell out of them. Cruise lines, So I think it's something that would be hard to predict that way. And I do think that over time, like we saw, the industry is much more commoditized in terms of very low differentiation, but only a few players, which usually if you have an oligopoly with not a lot of differentiation, it's okay. Like, it's all right. They may be value stocks from time to time. Yeah.
Mm-hmm. When you talked about dollar stores, so a little bit of a different market than the people shopping at Ulta, but want to get your thoughts on Ulta Beauty. Obviously, somebody at Berkshire, Ted or Todd, owns it, and want to pull it up on QuickFS and see what your thoughts are. The stock was up a bunch, really a bunch, like mid-single digits basically after they reported this week. But you could see EV to sales 1.7 times. Yeah, let's underwrite this, unpack it, and get your thoughts on Ulta from the perspective of looking at it on QuickFS.
Yeah, I think the thing that's hard about it is what we talked about before, which is that what if there are things that are different now than there were earlier, and that's likely to make for big changes, where it's like overpriced because, you'll have declines versus what it was pre-COVID, basically. I mean, I don't see a lot of that. The gross margin is higher, by quite a bit. It used to be 35%. Now it's like 39%. Revenue growth is higher, but not radically higher since COVID. Actually, it's only a little bit higher probably. So, it used to be pretty steady grower even in the years before that. And the improvement in the gross profit drops completely to the bottom line, right? So it's like 3% to 3% higher in terms of an operating margin. And, that's mm, would mean that your PE of, what is it, 16 now, if that reverted to what it was before, it would be more like 22, 24, something like that. So that's kind of what the concern is, that it might not really be that cheap, or when we looked at it before, I should say, that it might not really be that cheap. And for me, it's not something that I can evaluate, right? So that's the problem. But it doesn't look, on the numbers, it doesn't look like it. There's other things that changed a lot more since COVID than this. So, I mean, the bigger thing is the long-term thing, that it's an industry I don't understand. You're talking about something that went from 3 billion in sales to 11 billion in sales in 10 years. That's pretty impressive. Gross profit quadrupled. Operating profit quadrupled. So that's just, it was a growth stock before COVID. So I don't know if it's just purely something that's happened since then. It's way outside of what I can evaluate, though. And now it's not so much, cheaper compared to other things, whereas it was before. So, but yeah, financials, it looks like a great business, right? Like the returns on capital and everything that we saw. Yep.
Buffett or somebody at Berkshire had another interesting. We could pull up their 13 app that came out. Let's see, where is it at? November 14th. You could see he sold some more Apple, which was to be expected. Sold some Bank of America. Why do you think he's selling banks or Bank of America so much?
I think it's an age thing in those. I think that originally he didn't want to sell Apple and Bank of America, seeing them as more longer term things that he wouldn't sell, even if he thought that, he said Bank of America was a special deal. It was different than the other banks. And then over time now, I think he's been cutting those. So I do think that it's like age and transition related or something like that. Probably those two.
Mm-hmm. Sold some Sirius XM.
Mm-hmm. That went through we had talked about that before. Now it's one stock. Yeah.
Couple buys though. Oh, sold Ulta, right?
Yeah.
But bought Domino's Pizza and Pool Corp.
Yeah, very growthy stocks, right?
Yeah. Mm-hmm. So we could pull up.
Probably not Buffett purchases. Definitely
no.
not Buffett purchases.
Who is this? Is this a TED thing, you think? This looks like a TED purchase.
Yeah, it might be. Yeah.
Price earnings 28 times, EV to free cash flow 41 times. I haven't looked at Domino's in some time, but I did look at Domino's Pizza Group a couple summers ago. The
is that
one that trades in on the London Stock Exchange.
Okay. So yeah, there's the publicly traded one in the United States, which also owns which is basically the main parent company. And then I guess there's
one in Australia.
4 technically, something like that. Total, if you take all the ones that trade around the world, the UK, like you said, is the one that was pretty cheap compared to the US one often. Yeah. Mm-hmm. Although its results hadn't been as good recently. Although now the US one isn't so amazing either. So they're probably more similar results recently in terms of sales and things like that, like growth.
Yeah, I mean, growth slowed. It was negative 1.3% year over year. Now, how much of that? I mean, they're incredibly tough comps probably from when people were just ordering pizza a lot and staying at home during COVID, right?
Mm-hmm.
But gross margins have gone up a bunch.
Mm-hmm. Yeah. It's a really good business. Mm-hmm. But I mean, it's 20 times EBITDA or something,
So I guess it's a style that's different than like Buffett. I mean, he's never paid. I don't think he's ever paid a multiple like that,
No,
for a business.
No, never has. And then
Ulta was a quick flip too.
Yeah, although it's fair. I mean, we didn't check the stock price on that, but it's always fair to, I think, to flip a stock if the price changes radically from when you bought it or something. I mean, that's you can change your opinion for lots of reasons, but if someone bought Cinemark, it goes up 150% and then they sell or something, yeah, then it's kind of like the price is different, so you decide to make a different decision. But there could be other reasons why someone would do that too. Yeah, no, I mean, I think the turnover is higher in the non-Buffett part of the portfolio than the Buffett part. Yeah. And some of these are also smaller. They never got to be that big a position. So, you've seen that a lot more often. It's tended to be the very big positions, I think, even for the other portfolio managers, have lower turnover than the smaller ones, which they get in and out of faster, which may be like they never developed it into a big position or what happened. Yeah.
I think Bill Miller had said it's good to have a concentrated portfolio and then have, a part of your portfolio where you have a bunch of smaller, like 1% to 2% portfolio positions, just to stay active and basically restrain yourself from touching the the larger portions of the portfolio and just letting the swings affect you. Like having some activity to keep the brain active, kind of scratch that itch, if you will.
And they may do that, the other two. Buffett does not. Yeah, that's for sure.
Mm-hmm. Yeah, like a bunch of one. I think he said that. I think the actual quote was like 21% positions or something. Just to stay active.
My memory of Bill Miller's portfolio is that that's true.
Mm-hmm.
That the top 10 stocks or something might be as big as all the rest of the portfolio almost, but then there's probably a couple dozen 1% type positions. Yeah.
Mm-hmm. Mm-hmm. So on the last podcast, we talked about FICO and just the crazy valuation.
Yeah. Mm-hmm.
This is my other favorite incredibly expensive stock, Wingstop. And, they announced on the 5th that they're going to buy back another $500 million, or they add an additional $500 million to their share repurchase authorization. And this thing is trading at 100 times earnings. And it always trades at 100 times earnings, which is fascinating to me. But this was something that was interesting. So they added $500 million, and then in this 8K, they said with this additional repurchase authorization, the company anticipates executing a $250 million accelerated share repurchase program that will commence in the fourth quarter of 2024. So
That's
I was
the
just
concerned with FICO too. We talked about that when I bought it,
at 100 times earnings,
Yeah, well, it used to have much more impact. The share repurchases do when they're done at much lower, earnings per share, PEs. Yeah. Mm-hmm. They lead to more earnings per share growth because they're a larger percentage of the company. Yeah. Mm-hmm.
I'm like, are they just going to go out there and just start ripping, shares from the offer and just putting that money to work,
Yeah, I mean, it's a concern because if you look, let's go look at them. That's actually a lot of there. So it shows free cash flow there. Let's see, where are we? Yeah, if we look at the free cash flow statement, we could get an idea of why I'm saying this, right? So they are doing $250 million. Yeah, and their largest cash flow from operations ever is right now at less than $200 million. Yeah. Mm-hmm. So they're using all their cash flow from operations plus more to buy back stock. So that's great if your stock is cheap, and it's not so great if your stock is expensive. And so, it's kind of like if you have payment in kind or something type things, basically you're getting more shares over time. You're getting more ownership over time. You're not getting that money returned to you in any other way. Yeah. I mean, it's the world that we live in right now.
It's insanity.
I mean, the thing that's more a big deal, we should point out,
I
Domino's
love to own this
hard because they
a while ago, but it's just crazy.
It's a good business. I mean, it has a really good kind of unit economics. Domino's, FICO, those are all great businesses, and but it is, what did we just show? 18 times sales or something? I mean, that's trailing type sales, but I mean, the sales are sales might be going up 20% a year, but they're not going up, 100% a year. So it's going to take a long time to work that down into sort of a normal level. I mean, it could take, they have to keep growing at let's look at it to see what I mean. But if we look at the QuickFS thing recently, let's see how far, at the rate that they're going, it will take them 3 to 5 years of growing at this rate probably to get down to a just somewhat expensive, like an 8 times, price to sales or something like that. Now you are buying back some stock, but it's a very small part of that. So the stock price would have to go nowhere for like 3 to 5 years to get it down while it was still growing at like 20% a year to get it down to like kind of a normal price to sales. That's the problem that you have. I mean, it's kind of the question I ask people is like, okay, if the EV to sales is 18, as in this case, how likely is it goes to 36, and how likely is it goes to like 9? You have to kind of think about it that way. EV to EBITDA might be a great business, but how likely is it? Is it more likely it goes to 30 times EV to EBITDA than to 120? And if it's more likely, then the risk reward is kind of skewed that way. And that's the way that we have with all of these companies that are, while very good businesses, really high prices. There's just a really big difference when you're talking about 20 times PE versus 100 times PE. And we say PE, but it's all these numbers, as you can see there on every single one of them is really high. It's high on every basis. Yeah.
Could it just be that so much of the market is factor investing and momentum and pod shops betting on next quarter, next year, sales being higher? I mean, you talked about AQR. They release a report and have markets become more efficient or less efficient. And you had said that you agree with AQR that they've actually become less efficient. And I mean, so much of the market, I mean, that's the topic I wanted to discuss, because when we were talking about FICO, a lot of people had emailed me this blog post, What's Driving Stocks, and I could put it in the description. And somebody wrote a blog. So I guess this was a blog post that someone was allowed to post from a Substack. Okay. And he said, the other day I was chatting with a good friend and our conversation went something like this. I just don't understand why my stock is getting hammered. Sure, the near-term outlook isn't that good, but by 2026, this stock will print scads of money. And then the writer said, my friend then goes on this 5-minute rant about how this industry is set to explode. He explains the fundamentals in a way that I can only dream about, being half as articulate. He knows the story cold. He has thought through every angle. The short term is challenging, but he is completely convinced about the stock's long-term prospects. And I think he's quoting the person that's talking about the stock. I watch all the stocks trade, and the short interest is actually increasing. This makes no sense. What do these short sellers know that I don't? And then the writer said, you're thinking about this all wrong. You're assuming the market is efficient. It's anything but. I bet I can explain the movement in your stock over the past year. And he says, really, how? And he says, stocks are overwhelmingly moving on forward EPS revisions. I'll explain. And the person says, but why would they short something that's so cheap? And then he says, because these managers aren't thinking about it as an individual stock. They're thinking about it as a portfolio strategy. Let's pull up your stock with the forward EPS estimates and see if it correlates to the price action. And the stock price in this has correlated with EPS revisions and analyst estimates. And he says, you see how the periods of rising EPS forecasts, positive revisions, saw your stock price gain, and then look at what happened when revisions went negative. The stock price fell. You're wondering why your stock is getting hammered over the past couple of months, but it's obvious that EPS revisions are comping negative. And he says, in reality, there isn't just one factor like EPS revisions that could explain all the movement, but it was an easy prediction for me to make because this factor has become so important. And then he, talked about a different guy, but it's just momentum and quants that it's not guys like Marty Whitman or Buffett going out and like just waiting for things to get super cheap. They're betting on next quarter, next year, but also just momentum in general as a factor and just basically are price takers. So I almost wonder if that is going to allow things to really overshoot I mean, we know it overshoots on the upside,
Yeah.
but like overshoot on the downside as well. So I wonder how that all ties into, the market becoming actually less efficient over time, because prices really are going to become distorted for reasons where if you could look out next, 2 to 3, 4 years, you could get some pretty good opportunities, because so much of the market at pod shops, they're just betting on next quarter or the next 2 quarters. And if it misses or whatever, they'll just puke it,
Yeah.
I want to get your thoughts on that.
Well, that's the problem that you have when things get to be as expensive as the ones we talked about, is that where it really hurts is when there's a transition in the perception of the company usually. So, I mean, one is market environment, type of stuff we're talking about, but if financial conditions aren't really that tight ever or anything, then I don't know how much things change. I mean, truthfully, like, it's not that common, I would say, historically, for an entire market to re-rate to a more reasonable P ratio from a not so reasonable one without like a recession or something. Like, something usually happens that causes that. And it's more the magnitude of it that's determined by what that is, rather than just people suddenly waking up and saying, well, 40 is too high, it should be 30 or something. It's more likely that the distance of the fall or the recovery in it is determined a lot by that. So, like coming out of the Great Recession or something like that, or coming out of the Great Depression, let's say in the 30s is a good example too, then stocks go up a lot because they got so cheap, right? But they don't necessarily start going up until things are positive, or the perception changes that way. It's just that it determines more the size of it. And that's what I'm saying here. It's more how much upside do you really have versus how much risk are you taking? Is it just that you're taking an incredible amount of risk? And then the other part of it is the transition, is that at some point there's a change in perception of the company, where the perception of these companies is very positively growth-like, and that's not always the case. FICO, I was just as an example, because, Wingstop's not a good example because it went public and it's been like this the whole time and everything, and it will change its perception eventually. But FICO is easy to do because it was perceived as just like a value stock, back in, in say like 09, 2010, 2011 even. And then it's completely re-rated to a different level, right? So it's easier to see when you have that example in the same company, for people to see that transition happens, that things that are once considered great growth stocks now are value, or vice versa. Whereas the new things, it's always hard to tell that will eventually happen to them. But it happens even we've had a huge change in Facebook from 2022 to, I guess, to now or something. So, I mean, it's got to have had a couple years in a row that were amazing in terms of multiple expansion and everything. So it was perceived at one time to be almost as cheap as value stocks that we talk about, right? And then that changed. If you can predict, what the change in how people perceive a company will be, then that's how you can be very successful. And that is one way that in the long run, Buffett was very successful, is finding things at a time when people didn't recognize how great a business they were, and then holding them as they were re-rated to be really considered something special. And that's kind of the case of what happened with FICO, I think.
Mm-hmm. I mean, the other side of it is, look at Celsius, right? How expensive that stock was. And as soon as growth slows, I mean, we're down from about $100 to $28, and you're still at, I mean, how many times sales? I mean, we've talked about this on the pod. It was like 4 times or something like that,
Okay. I mean, Celsius and Wingstop and those are a little different because they're really competitive businesses. Mm-hmm. So they can grow a lot faster. Celsius grew much faster than FICO ever did. But then it can also change in terms of the profitability of it and everything, and people's perceptions of a way that make it a lot more negative quickly, which is less likely in something like FICO. But that doesn't mean it still won't re-rate by a tremendous amount. I mean, some of these, they could decline by 2/3 and they wouldn't be particularly cheap.
Yeah. Mm-hmm.
If you have a P of 100 or something. So, yeah, I mean, let's see. I mean, what is is it FICO? I mean, over 10 years, is it high single digits revenue growth? It's not even
It's
that,
not a
right?
lot. No, I think
Yeah, it's 8%. There you go.
I think
So
what's
it's the
baking
earnings per
in is
share.
EPS
Yeah.
growth, raising prices. People, I mean, from us posting that and people responding, they're like, they could raise their prices 3 or 4 times and people wouldn't blink an eye.
Yes. I believe that's true because when I looked, I believe that almost all the increases that I could find in the last 2 years are probably explainable by price increases. Obviously, it's a little complicated. They don't have just one price and everything. But you can see that, obviously with gross margin of what happened there, that's one of the easiest ways to tell. But even just really the operating margin doubled, and that was mainly, I shouldn't say mainly, but, you had a really big increase in the gross margin. Over 10 years, you had an increase that's really surprising from like 68% to 80%. But also some of that is, maybe what they focus on stuff because gross margin probably was always like that in their best business. So I don't know. I mean, if you look though at the share buybacks, that's the part that fuels concern for me of like the feedback into it of this isn't necessarily. So if you look at, let's see, where do we have? Okay. So free cash flow. Okay. Let's see. Yeah. So you see, okay. So you have diluted shares. So you can see that there's been a big decline over time in the diluted share count, right? Okay. But if you go to the cash flow statement, you can see what I mean. So in 2015, they bought back 130 million, right? And that was 6.5% we saw the share count went down. So, I mean, it was probably even more than that in terms of buybacks because they probably had some share issuance too. There was stock-based comp there was. So that really made it decline a lot. Now they're spending 800 million on buybacks to achieve a lot less, So that's the problem is that they're kind of buying in at that really high price. That's probably the other part that kind of concerns me about it. But, and a lot of companies do that. Share buybacks are not always the best timed, right? So sometimes companies do them at prices that are like, because at this point, the company had mostly, because they did increase debt over time a bit, is my memory. So for most of the last 10 years, they've almost spent 100% of operating cash flow from operations on buybacks, which is, not bad. That's really good. And so the fact that the company requires almost no capital and that it grows through price increase and stuff, it's like a See's Candy that way. And so where with See's Candy, they paid that on dividends to Berkshire. Here, they've used it all to buy back stock.
I mean, it's crazy. I mean, look at their cash flow from operations and then look at what has to go back in PP&E, CapEx, right? And even looking at their income statement, I mean, it's the margins, everything are just so impressive.
Yeah. Yeah. And so as we can see here,
this is basically human capital, as they say, That's really where a lot of their capital has to go to, or expenses.
Yeah. And
they're not going to build
human capital out there. They're mostly just a technology.
I mean, it's crazy. I mean, it's not like you're going to build like a massive gigafactory or you have to increase capacity or anything like that. What do they have to increase bandwidth? Maybe. And even that's cheap nowadays.
But it is interesting just to note on this. So in where we see from 2015 to trailing 12 months, you can see it's pretty much exactly a doubling of revenue. Now let's go to the key ratios to see how much from 2015 to today the market cap changed. So if you see,
went up a bunch.
So market
from 2.6 billion to 47.4 billion.
Yeah. So we're talking about a market cap that went up, not quite, but close to 20 times on a 2-time increase. Yeah. So it's a 10 times increase, probably. Yep. It's a 10 times increase by some of the, price multiples and things like that.
Mm-hmm.
Not as extreme as that because they bought back some stock too. But, yeah, I mean, we've talked about this before. Look, if you can predict changes in the multiples, then that's going to matter more over most holding periods than the actual business performance, unless you're in some really amazing businesses. Now, something like Celsius is growing so fast that, if you can pick things that grow 100% a year, then the business performance will matter a lot. But for most other companies, if you can find things that, even if something doubles in 10 years, to offset that, you would need to have like a difference in terms of business performance, like 7% or something. That's a big difference. So, avoid things that are going to be cut in half and find things that are going to, double their multiple expansion, and that'll make a bigger difference than the growth. Yeah.
I mean, why did Apple get such a huge multiple expansion? I mean, sure, revenues mid-single digits, right? I mean, let's call it 8%, done well. But a lot of that, as you can see right here, came from 2021. Other than that, it's been kind of a lot lower. But the multiple on that stock went from less than 10 to now, what does it say? 40 times.
Yep. I don't know that these things are always easy to predict. I do think that Buffett probably bought Apple at a time where it was transitioning, though, from one type of holder to another, which is your big opportunities and your big threats of when, you find something that was an attractive growth type stock, it's no longer, and now you find it in terms of quality or whatever things. It's just shifting from one kind of bucket of something to another, But yeah, everyone wanted to own Apple at some point, just as everyone wanted to own Meta, and at another point they didn't. And it's hard to remember that a few years ago. We've talked about that with Microsoft too. That's happened twice probably in Microsoft's history. That it was pretty cheap and then it got to a very high price again. So it's been perceived as being really good quality.
Do you have any thoughts on like the momentum factor and how that affects prices? I mean, a lot of people, a good amount of people, response to the FICO pod was sending us this blog post and wanted us to bring it up. How it seems like a lot of the price
I don't think it'll stop working.
Flows and whatever. You don't think?
I don't think it'll stop working. It's the same thing I've said with like AI things and stuff. Even if there turns out to be a bubble in those of overspending, it could go on for a really long time because someone would have to note. It's so far away from the consumer, and someone would have to notice it. Here, I mean, people, if they keep holding the stocks and keep counting them, if you count them in your brokerage account 100 times earnings or 10 times earnings a stock, and you just go by the market value, it doesn't bother you to own something that's 100 times. You just say that's what it's worth. I could sell it tomorrow for that, and that's true. I think ultimately it doesn't really. It's a difference between frequency and severity here. I think people like winning, like things going up that they own with a high degree of frequency. But the problem with that is eventually that could mean that you have very severe losses for not very severe upside potential eventually. And that's I just think something's a lot more likely to decline to 50 times earnings than to go to 200 times earnings. But, if you look, FICO started the year quite expensive and had I don't know if literally year to date. Yeah, probably because we're near the end of the year or whatever. You could see, I mean, it probably was pretty expensive, and then I don't know if it was 60 times earnings or whatever it was, and then went to like 100 or something. I mean, like it went up a lot while the PE ratio expanded while it was already at a really high level. So, right?
Yeah. You think stocks tend to overshoot on the upside more than they overshoot on the downside?
FICO overshot on the downside pretty severely. I mean, I think when I bought FICO, I probably thought it was worth 3 or 4 times more than what I was paying or something. But that means I think it's worth 60% less than what people are paying now, So, I mean, it overshoots in both directions. Like it traded at 10, 11, 12 times free cash flow probably. It was probably worth 30 or 40. It's probably still worth 30 or 40. You know what I mean? I mean, if we mean something that we buy and hold forever. Now, if you mean trying to predict other things, that's a different story. That you could be in too early. They would spend years. I mean, if you look there, it spent, what is that? If we look back at 2000, yeah, you have it on that line is like the median or whatever. I don't know what you have on that line, but like 20 times basically, or 21 times it shows. So it stayed for several years. In the 2000, I don't know, 2008 to 2015 almost or something. You probably could have kept owning it for a long time as almost a value stock, then accelerate a lot more from them. But people probably would have been a lot happier if they waited a few years to buy it, and have it go up rapidly. Then they would have felt a lot better than if they owned it for, long periods of time. where, it wasn't doing quite as well. But the earnings per share growth was actually pretty strong back then, because remember, they were buying back the stock like we saw 6% a year or something. So, yeah, I don't know. I mean, we can look at that P/E ratio and see what happened recently, and get an idea that a lot of that is just in the last 2 years or so. So, but it works. And the same thing, we see that sometimes with Shiller PE things where they're, looking back at the past, it seems easy to say, oh, it was too high or something. But if it makes an all-time high in it, which it basically has with the P ratio, that means that at its previous all-time high, it's gone up like 50, it's almost doubled in PE from what was almost like an all-time high before. And people were probably saying it's too expensive at the all-time high before. They'd look and say, look, it's never been this expensive in 30 years, or it's rarely been this expensive, and then it doubles from there.
Mm-hmm. That's a good segue to a few emails that people had sent in. So another question somebody had emailed in, they want to know about your piece about how someone should invest with just 1 hour per day, right? And he said it makes sense. He said, my only question is, if someone adopts this playbook, how will they know what stock to sell when they find a new stock to buy? Assuming they're doing no maintenance work on existing portfolio holdings, it'll be challenging to know when to sell. I wanted to get your thoughts.
I mean, you'll have to spend some time thinking about what to sell. But it's not trying to be that hard. You just list what things you own and which you like best to which you like least all the time, on a pad of paper or something. It depends on what kinds of things you own. But if you own Buffett type things and you're reviewing them once a quarter, you don't need to do more than that, to know if you own those things that we talk about, most all those things. I mean, most stocks that we talk about on the podcast, you wouldn't need to revisit more than once a quarter. And then it's just a question of which do you like least, and that's the thing that you sell first, So basically, to have a pecking order in your mind at all times about what you would sell if you had to sell something today.
Now, is that based on price, or is it based on quality? Is that like, okay, I think the IRR of this company could, like, over the next 5 years is 15% versus other one that's 20, and I also think it's a better business. How do you think about that in your head?
I mean, it has to be based on all those things. So it has to be based on both, price and quality, basically. So for instance, you would sell something like FICO for 100 times, but you wouldn't if it was, 20 times or something. But then if two things were similarly priced, but the quality was different, then, I mean, we're talking about something that's very different. What we've been talking about is something that's very different from, say, the Buffett type approach or something. But the approach of someone like Buffett is to say, look, it doesn't matter what the market puts values of stock at day to day. And I think that's the approach to use. And so if that's the approach that you're using, you're just saying there's a trade-off with price, that a higher price means you have to get more from the stock in terms of growth and in terms of those things to make up for the higher price for over a longer holding period. So then you can afford to hold it for a longer holding period. It can grow into its price and it can still do okay for you if it makes up for that. So with the FICO example that I gave, it's perfectly reasonable for someone to think that at 30 times earnings, that it would get market type returns or something. It's hard to believe it at 90 times, and it's really easy to believe it at 10 times or something. So, it's kind of like a horse race. It's the odds, you're not necessarily betting on the favorite. You're betting on what has the best odds relative to what you think the real probabilities are.
Mm-hmm. How do you think Buffett thinks about it in his head?
Yeah, what he's most sure of is doing well enough. So I think we've seen that, look what he sold and what he hasn't sold, right? So he's selling Bank of America, but isn't selling American Express, selling Apple, but isn't selling Coca-Cola, So some of that may just be things he's owned forever, but some of that is also what things didn't get crazy expensive. And so it's okay to hold on to them. So things that he had a lot of certainty about, but also the prices were pretty reasonable. And then maybe to some extent, things that got oversized. Apple's a rare example of that, but normally he wouldn't do that. But maybe Apple got so oversized that he'd be willing to trim it, which is not something you would normally do. So that's the other thing for people to consider, is you might have things that you want to trim if they get to be an unusual size of your portfolio, and people make that decision based on how much diversification they want and how many different stocks they want to own and everything. But so should you spend a couple hours on stocks you already own? Maybe. But I don't know if you need to spend more than, 5 hours a year, what we were just talking about, if you're spending about an hour a quarter or something on it. If you have a few stocks, you could spend a lot more time on it, and that would be fine. But if you want to own 30 stocks or something, then it's going to be hard to do that. I think that most people's time would be better spent mostly focusing on finding a really good new stock to buy and not so much worrying about selling the things they already own. We just talked about stocks that are at really extreme prices. That doesn't normally happen. Normally, you could buy a FICO, hold it for 10 years, and it would never get to a ridiculous price. So you make the right decision one time, and it's okay, and you don't have to worry about it. I guess you can worry about things if they're in the triple digits and stuff. You made all the right decisions, but the price got too expensive, then yeah, you could worry about it a bit more. But for most things, it's not going to matter that much. And if you own 10 or 15 stocks, you're not going to have to worry too much about that constantly evaluating, price versus where they are now. I think your time for most people who aren't like professionals would be better spent finding a really good new stock to buy than worrying too much about what they already own. Just because your already owned thing is always focused much more short term, to be honest. You've owned it for a while, and so you're always looking at really short term. What's the price now? What was it before? Should I sell? Just like it creates too much action that you're doing just because things have changed a little bit because you know it so well. And you kind of have a tendency not to be able to see the long term when you actually own it. You see too much of the period by period kind of results.
What about the thought process of what you don't own can't hurt you? So if you do own something in the portfolio, and maybe is it just the nature of what, the companies you focus on, if you're buying high quality businesses, they probably don't change as much. Asset growth or competition is probably a lot less than other companies. I mean, how do you think about that?
Yeah, I mean, if you bought Cinemark and it went up 150% or something, then obviously, yeah, you should think about, should I sell it? Have things changed a lot? Or have things changed because during COVID or something? I mean, you want to use common sense about those things. So obviously you would revisit things during COVID about airlines and movie theaters and whatever, because suddenly there was this big change in the business that you weren't expecting. There's nothing wrong with, selling something quickly after you buy it because the world's changed a lot or because the price has changed a lot. So it's totally okay to quickly turn over a portfolio. To totally turn over a portfolio if like something like COVID happens or something like a stock goes up 100% or something like that. And the same would happen the other way. There might be a stock that you think, oh, I'd really sell this, and then it goes down a bunch, and then it doesn't make sense to sell it, for it to be the top thing that you would sell. So, I mean, the idea is if you really only have like 1 hour a day, that kind of thing, which the idea
that's what the topic was of this. Yeah, that is what the post title was. If you only have an hour a day, yeah.
And the reason for saying 1 hour a day is because everyone should, if they want to do this, have 1 hour a day. That you can do. If I said you have to have 4 hours a day, then people would say, well, then I can't invest my own money and everything. But people can find 1 hour. So yeah, I do think that the vast majority of people that I've talked to would be really better off if they just worked really hard to find the next best new idea. And the reason why they sold was simply to make room. Like if they just said, I'm going to have a 12 stock portfolio or whatever. And the way that they sold is that they really, really wanted to own something new. So they had to bump something off, and that's how they decided to do it. That would probably work better for more people than deciding I'll sell to hold cash or something. And then, and spending a lot of time selling. A lot of people spend a lot of time thinking about the things they already own, instead of finding new ideas. So I would discourage people who don't have a lot of time from doing that. Don't spend as much time worrying about the portfolio you already own. Spend a lot more time worrying about finding something new that's really good.
If you only have an hour a day.
If you have a lot more time, though, I would still spend a lot of time looking for new things. But yeah, you could spend some time reviewing your portfolio that way. But I do find that most everybody has a much more short-term focus when looking at the things they already own, because they're just looking at the rates of change of they forget how much they know and stays the same, but a lot of things stay the same. And when they find a stock for a first time ever, they can take kind of a longer term view than something that they own and they're really worked up about how it's changed while they've owned it. And they kind of see more change in it than it really is. It's a lot easier to look at the long term for something that you've never owned before,
I guess it also depends on the type of company you're investing in. If you're investing in like a Costco or a Wingstop or a FICO, where again, like it's not like a cyclical business, where you're like, okay, there are cycles to this and this thing will have more challenging times and you kind of want to pay attention to capacity and all that other stuff. I think it
yeah,
does
I'm being very
matter on what you're
simplistic in
focusing
this. It would make a ton. You might want to be looking every week at an arbitrage situation, spending hours on it. Yeah, but that's because things are changing all the time. There's new information that really might move the stock. You just have to kind of think that way. How much really is there that could change about Costco other than big changes in the stock price from quarter to quarter? Other than very big changes in the stock price, there's not a lot that should be making you decide to buy or sell.
Agreed.
Yeah.
So another question. So if people listening want to send in questions, email me, andrew@focuscompounding.com. Somebody asked, kind of more on what we were just talking about, how do you think about valuing a cyclical business? The traditional DCF mindset when valuing a cyclical is tougher because the numbers can be all over the place, especially if I'm around the trough or the first few innings of a new cycle. Should I simply think about what a business can earn at certain points in the cycle and throw a multiple on it? Should I just buy below replacement value and wait for the cycle to change? Sometimes I feel like it's hard to put a numerical value on a business, but I know that if I'm buying something at trough earnings or way below replacement value, and I expect the industry to come back to life, that could still be an interesting situation to invest in. Sort of like Buffettism of not needing to know someone's weight to know that they're fat. Do you agree with this? How do you think about valuing cyclical businesses after an industry has gone through a downturn? Long question.
Yeah, I think one, it's tough for people because it's always going to go way past what you're thinking, not always, but it'll probably go way past what you're talking about with like, should I, pick a earnings that I think it'll hit and throw a multiple on it. For a cyclical business, that could be way, way off. So you're going to have a number that's off for what it'll be a few years from now. And so it'll end up that you think that you should sell at $10 and the stock goes to 30 some dollars, but actually it does that on pretty low earnings. The tough thing is the Peter Lynch type comment, which is true, that the cyclical business, it may be expensive when it actually has a low PE and cheap when it has a high PE because the earnings are almost nothing at that point. So that's going to mean that you should look at things like book value. You might also want to look at things like sales, things that are different places in the, besides just looking at earnings. For things that we can value commodity type things on, measuring the capacity and all that, if you really understand that as well as other people in the industry, which sometimes can be hard to make that evaluation, then just appraising it on what that's worth might be a really good way to do it. But you would also need to evaluate its financial situation and if the industry is going to go away. You kind of have to say, okay, this is an industry. So, take an extreme example like steel or something. Steel's not going to go away. So you would say, okay, am I sure this business is going to survive? And then, yes, you could use like replacement value and things like that. And there are people in the industry who know that kind of stuff and would say if you'd have more confidence if it was much cheaper to buy this business than to build what this business has. I mentioned that with supermarkets. There's some where it's like they're pretty cheap compared to other things, and it would be hard to replace what they have. Now, you lease it and then you spend a bunch of money and stuff. But so, I mean, some of them own their real estate, but it doesn't seem like it's quite the same thing. But it would give you much more confidence if you say, okay, I think it always gives you more confidence if you say it's hard to bring in capacity that would be profitable at a lower price or something. It's hard to replace that you're getting something cheaper. But there are industries where you might wonder, well, should anyone have ever bought this? Is it misplaced? Is its location bad, for instance? That'd be the most obvious one. It could be out of date technologically or other things, but the most obvious one would be like just not good location, and this isn't where people would build it today. And then maybe it's not worth what it was originally bought for or built for.
What's the most cyclical business you've ever invested in?
Shipbuilding related, probably.
Oh, okay. Mm-hmm.
Yeah.
Mm-hmm. Because a lot of value investors love to spend time there. It's cyclical companies.
Mm-hmm. Yeah, and I think there's times when they've been attractive. I wouldn't rule out cyclical companies necessarily. It's the same thing we talked about before, though. You have to kind of apply a discount to cyclical companies versus other kinds of companies if their average earnings over the cycle are lower, and people tend to overestimate that and think that it'll own pretty average. It's much easier to achieve your returns on capital goals at a much lower cyclical business than a higher cyclical business, because the reason why a business is highly cyclical is because there's some degree of miscalculation by some people in the industry. Otherwise, it'd be pretty efficient and they'd all figure out what they should be doing, and there's no mismatches and these shortages and everything wouldn't happen in the industry. So there's some misallocation of capital in a cyclical business to some extent, but it could be in your favor at some times that there's not enough capital in it as there should be or something when you get in. So I think we've brought up cyclical businesses from time to time, we brought up Seaboard or something, and that was when it had like no earnings. So that's why we would bring it up. I'm sure we brought up oil things or something like that at times where the price of oil wasn't particularly high or something. So, use common sense in those areas, but the time to buy into something often might be when it doesn't have a lot of earnings, but it looks cheap versus assets.
Yeah, replacement value. You think the industry's going to come back, or that's why I like it. I mean, when they go through a downturn, people just get hosed. And so it's like if capacity comes out or they scrap stuff, then there's less of it. And then when things finally start to turn, prices, day rates, whatever, could be higher. And everyone in the industry hates it. Those could be great opportunities.
There's also different kinds of cyclical businesses, I guess. I mean, the big problem with some cyclical businesses is they only, and this is kind of the definition of a non-franchise business, a true commodity business. They will only earn high returns on capital in years of like a shortage of unusual things in the industry. And that happens even in technology things that we've talked about, semiconductor things where they can go through long periods where they don't have very good earnings. It can happen with, what do we talk about? A-Mark Precious Metals is a good example of something that like it doesn't sound as commodity-like as something else, but gives you the same idea where there's the tightness of supply. You saw that in some COVID-related things. If you remember, there were those like protective gear type companies and things like that where, okay, so you can see what the long-term history is, but you can always see that, if there's too much demand and not enough supply in an industry, then almost any business that doesn't sound like a great business can earn really high returns. When we talk about what a great business is, it's the ability to earn good returns even when there isn't some industry-wide shortage. All businesses are capable of like passing the magic formula in the right year for their industry. If something strange happens and there's a shortage in the industry, which can happen in basically any industry. Yeah, so you can see there they went through like a decade or something where their returns were, mediocre, and then they make all their profits in a period of a few years. But if you read about what the company is and what they do, that's not that surprising, Yeah.
I think the pitch with A-Mark is they've consolidated, they've acquired a bunch of other stuff. So if there's ever that speculative boom or the industry's different, they're going to benefit better from it or something like that.
Yeah, and something like this will just have a bigger balance sheet and be way bigger. We've done that with steel companies and things too. They won't go back to where they were before. Their returns on capital could end up getting a lot closer to where they were before, but they'll have so much more capital that it'll still work out for you. They're not going to go back to the same earnings per share that they had some years ago, but there's also just more capital. They're like their book value and stuff will be a lot higher than ever was before, Yeah.
It's easier to own the FICOs, but it's more fun to own the steel company, the shipping business.
Yeah, I mean, A-Mark is back to almost 1 times book value or something. Like it's not even at a premium to book right now, I think is what QuickFS says. Yeah, and it's up a lot from where it was before. So obviously book value went up a lot. We could check the key ratios to see that because I think it has tangible book there. I'll give you an idea of what I mean. That even if it goes down to where it was, let's see. Yeah. So if you look, it went from tangible book, I don't know if they issued shares. Do they have per share book value? Yeah, they have per share book value. So it'll end up being about 4 times higher than where it was probably, right? Tangible book, not quite as much. Okay. But, so if it goes back to having the same returns that it had once before, you'll still be doing a lot better because you have so much more capital invested in the business if you owned it from back then. I mean, I think those things for most people are easier if they own, like, if they can find 20 of them, right? Because then they don't have to worry about it. They just buy things that will make a lot of money if they ever have tight supply. Because, I mean, at some point it would be hard to predict that it was going to happen. In this case, there's like a COVID related thing. That's not the only factor, but it could be hard, or you have to, discover it once it's happening. So I think it's hard for a lot of people because you could sit for years. The same argument probably made sense in 2015 as 2020 with this company. And so some people were in it and doing well in a year, and some people were sitting around for 5 years before it started to do well.
Mm-hmm. I think the pitch is that like shipping companies or like Seaboard, I mean, whether this is true or not, I think those companies are harder to value than probably like a FICO that's in like a steady state.
Yes. Yeah. I agree with that. But then also that would make perfect sense. But the weird thing about FICO, right, is the extremes.
Yeah, it overshoots like crazy. Yeah.
But why does it do that? Yeah.
I don't know. I think that's the theme, though, of just the market in 2024, 2025 in general. Just the way that the market works now is that you're going to have extremes. I mean, think about that. We talked about it on the podcast, but I listened to a podcast where a guy worked at Citadel. And he said, look, if we own something for 8 months, 9 months, and we were down on it or didn't move, we cut it because momentum was such a big factor. People selling or buying for just reasons that are so reflexive, non-economical reasons, basically. And that's reflexive. So that's why I think when people ask, has the market become more efficient, less efficient? I think that's the answer, is that you're just going to have more extremes of overshooting, of undershooting. And as an investor, I think that's a pretty good opportunity for you,
Yeah. Do you think, though, that like 20 years ago, there was some pretty big extremes too? So I don't know how much of it is, back 25 years ago, the .com and everything. So, I mean, let's see. How far do these charts go back? They go as far as you want them to go? Okay, so if you pull up like MicroStrategy, is it good? MicroStrategy, is that what I mean? Yeah, try that one.
The Bitcoin one?
All right. Well, yes,
issuing
but
bonds to
I
buy
think
Bitcoin.
You'll
basically
see something.
A bet on Bitcoin going up forever.
Well, but that's not what it's always been its whole history. And if you go all time, I think you'll see something here. Can you go back that far? No, it doesn't go back that far.
Yeah.
It does? Okay. All right. So you can barely see that on the chart then. But it was once at a very high price. There you go. That chart's good. Yeah. So it took 20 years to get back to the price that it was at in the 2000 boom. So, these things do happen. FICO, we couldn't quite find something as extreme in its past, but we did have a point where it was really cheap. So it's easier to come up with that where you can't find another example in the past 20 years, something like that happened. It's rare for it to happen in the exact same stock like this. That's unusual. NVIDIA, I mean, it's so much bigger company now than it was then, but something like that, you can find examples where it had a really high P multiple or a high whatever, and then didn't for decades and then did again. So I really don't know. It's hard to say. Things got a little crazy in the 1920s in some stocks. They got crazy in 2000. So I don't think it's like a completely new thing. I think the biggest issue has been the length of time for people. But, outside of COVID and some other things, I don't know how tight financial conditions and stuff have been all that often. So I don't know how hard things have been tested. There've been a lot of months of some expansion in the economy and everything. So I think it's just more an issue of like the consistency of it rather than the extremes. We did cover some extreme stocks, but there have been extreme things before too. I just feel like the length of time that's lasted is more like when we talk about FANG or something like that, is more people saying this has worked for years and years,
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focused Compounding Podcast. If you have a question you would like for us to go over, email it to me at andrew@focusedcompounding.com. If you're watching us on YouTube, make sure you hit the subscribe button. You will be notified whenever we upload a new podcast. And of course, if you're interested in learning about our money management services, you can reach out to me at andrew@focusedcompounding.com. I want to thank everybody so much for all the support, and we will see you in the next podcast. Take care.